just to reiterate on this long-term count, I've gotten several emails where the projection of a grand super cycle wave 4 that is fits right in with this long-term wave count. I wanted to show you how that was derived, and I'll turn off the video of myself. See you at the end. And I did show this. There's quite a few new subscribers recently. I wanted to show this for those that didn't see it before. This is Peter Goodburn's count, super long term, and Proctor has a similar count, going back hundreds of years. This is back to the 1701. And has that tulip mania or the South Sea bubble, and and some other things, going back extremely long time. But it sets up a wave count where they've taken economic data from the European history and tagged it on to the beginning of the Dow Jones Industrial Average. It started in 1900. And it sets up a wave count, and this basically sets up the 1929 high as a supercycle wave 3 high, and the 1932 low as a supercycle wave 4 low. And we've seen this ongoing secular bull market from 1929. That if you set up some Fibonacci relationships here long term, Goodburn had set a target for the Dow Jones Industrial Average up around 38,223 some years ago. Now, that is counting on an extremely extended wave 5. So the super cycle wave 5 to end grand super cycle wave 3 has been going on since 1932. And normally you wouldn't set a target initially where the fifth wave was a 1.618 expansion off of the bottom of the super cycle wave 4. You'd set it lower than that. You'd set it maybe at equality, or you originally actually would set it at where wave 5 was 0.618 times the net travel to wave through 3, and that would have set a target around 8,000 in the Dow. So, and that was even a fairly extended target, but the move to the upside has become extremely extended. This chart includes data through 20, that looks like about the end of 2017, early 2018, just prior to that correction, expanded flat correction or expanding triangle correction from early 2018 through March of 2020. So this is prior to that occurring, and set a target up here of 38,223. So when you're looking at that long of a chart and you're expecting the end of an extremely extended fifth wave to end a grand supercycle wave 3, then there would be a grand supercycle wave 4 next. And even if grand supercycle wave 4 only retraced the entirety of grand supercycle wave 3 by 0.23 or 23.6%, a fairly small retrace, it would the Dow would move back down to 3,600. So that's kind of the idea of a once this grand supercycle wave 3 is done, there's going to be a significant pullback. And if it pulled back to just the wave 4, this last cycle degree wave 4, that would be the 1974 low. Since this is an extended fifth wave up from the 1974 low, one would therefore expect that it might only pull back to the extreme of wave 2 within the extended fifth wave, but that's still down at 730 on the Dow. So a protracted and significant move to the downside in the Dow is what an Elliott wave technician that does go back prior to the data starting around 1900 in the Dow Jones and adds that European data on to the beginning of it, that's what both Goodburn and Prechter are calling for. And I've gotten several emails about it where it's an extremely worrisome situation, and how could that be possible? And I wanted to show you one idea of how maybe not something that big. Maybe it's a more it gets a bit of lift from the Fed, which it probably would, and it doesn't go down nearly that low. But I wanted to give you an example of how overvalued this stock market is, and I'm showing that on the S&P monthly chart. I'm going to shoot to that real quick. So the P to E ratio today is 45. Now that came off the tongue pretty easy, didn't it? But that is an unbelievably extreme number. But yeah, the P to E ratio of the S&P 500 index to today, and this is based on actual reported earnings, not forward earnings, which is a big game that they constantly play. But no, this is basically on reported earning. It is at 45. So how does that fit in to historical P/E ratios? And here's the S&P price to earnings ratio going back over 100 years. This isn't quite up to date. It's up to date through February 1, and on February 1, the P/E ratio of the S&P was 38 and some change. So just here in the first half of February, the P/E ratio has screamed higher from 38 all the way up to 45 now. And this is what they talk about, when we're obviously in a bubble, because this sort of thing doesn't happen very often. Back in January, March through March of 2002, the P/E ratio got up to 45, which it is currently now. The amazing thing about that, though, is that was after a multi-year correction, where even after a couple of years of substantial downward movement in the Dow Jones Industrial Average, still overvalued, tremendously overvalued, because the profits were poor, and prices never really did get adjusted back down there. And then, of course, the move in 2000 to the upside, it didn't. I can't even register a number for on this chart for what the P/E ratio is right there. It may have actually gone negative for a minute, but there were so many .com stocks that weren't making money. They were making negative. Here's another way to look at it. It's the Shiller P/E ratio, and as of the end of February, it was at 34. It's probably up, over 40 now, and it was already higher than the P/E ratio at the peak of the 1929 Roaring Twenties mania high. Only 2000 stands taller on that measure. I wonder if I can set that to the 14th and see if that can make that bring in just a little more data. No, it's just monthly data. It's a monthly chart. So the reason I'm showing that is, and I explained this, wrote out an explanation for one of the subscribers that just, it's hard to imagine the stock market would crash all the way back to when he was first investing in the early 80s, and that's also when I was first investing. But the P/E ratio today is 45. If you look at that chart one more time, let's see if I was smart enough. No, I closed it out. Let me see if I can find it. It basically shows a band of fair value on this green band running right through here. That's a band of fair value, and I can tell you that band is somewhere in the 14 to 15 range. That is historically, going back over 100 years, considered to be a fair value on the S&P, 14 or 15. So let's just say 15 is the fair value. Well, that's exactly 1/3 of the current P/E ratio. So if the P/E, if all else was the same, and companies were making profits just the way they are today, if the market was trading at fair value, 15, with a P/E ratio of 15, the S&P would be at 1,300 today. So that exemplifies how extremely overvalued, historically, this market is currently. And now moving back to the Dow, I'm expecting the Dow Jones Industrial Average is going to top up here. It's probably around 42,000. So the question is, what's the P/E ratio going to be when it gets there? If it's 45 now, if it moves all the way up to 42,000, another 10,000 points on the Dow, is the P/E ratio going to be 60 then? 80? What's it going to be? It's something probably higher than it is now. And therefore, if the Dow Jones Industrial Average, bring up my trusty calculator, let's say it hits 42,000 and has a P/E ratio of 60. Well, in 1982, the P/E ratio was 8. So let's say that we just drop from 60 to 10 on the P/E ratio. So we would divide, let's see, 42,000 by 6. So they'll get us back down to 7,000 on the Dow. I can see 7,000 on the Dow, and that would be a move back essentially to the 2009 lows. But the valuation in today's market, I think a lot of people don't realize how unbelievably historically overpriced the market is right now, in comparison with traditional norms. So I wanted to make that explanation, and I know this is expectation of a large move to the downside once we get the Dow hits up around 42, 43,000. Is a drag for many of you, because I have a lot of professionals that are subscribers. They're in the market. There might be money managers, but I think it's worth considering what these longtime Elliottians are expecting, and how big of a pullback it could be if it just pulled back to the wave 4 of one lesser degree. So that being said, I'm not calling a top. I think that we are in a bubble, and I think the bubble is going to continue to bubble up for a couple more years. But I think it's worth making some plans for, what could happen to a lot of careers after a couple more, if this roadmap pans out. I know, and so one guy goes, "Aren't you worried? Aren't you worried for yourself and your grandkids?" It's like, hell yeah, I'm worried. I'm very worried about it. But I'm not going to put different numbers on my chart that make me feel better. That's, as an Elliottician, we have certain rules and guidelines, and after an extreme wave 5, a extended wave 5, likely move back to the wave 4 of one lesser degree, or at the very minimum back to the extreme of wave 2 within the 5th wave. And I don't think there's any doubt on the long-term chart that we're in a massively extended fifth wave. But there are some Fibonacci targets up here, up in the low 40,000s on the Dow. There's a cluster of them between 41,020 and 43,650 that I think are the stock market's going to hit over the next couple of years. But once 5 waves up is finished from the March low of last year, then I think that's, according to a number of experts in the field, going to be the super cycle wave 3, a grand super cycle wave 3 top. So yeah, it's worrisome, but I'm not going to shy away from it just because it is. But at least on the shorter term, we have this market that continues to go up, trying to count it on the way up and five waves up now. Yeah, and it's, the Fed, I think, the Fed came into existence back, around in the teens, around in here, 1913, something like that. There's been some crashes. There's been 1, 2, 3, 4, 5. You might even count this most recent one as five or six crashes over the last 100 years, Fed or not. And so, and they are constantly talking about how their tools are limited. And the thing that limits their tools, which basically the printing press, would be inflation. So if they get if we get inflation, and I think we will, up through probably 2023, some burning inflation that they keep saying that they have a hard time hitting their target of 2%. What if it really starts raging out of control over the next couple of years? That will end the printing party. They can't print in the face of big inflation. And they, to be honest, are constantly changing the way they measure inflation so they don't have to tell us how much inflation there is. But at some point, it will just become obvious to all of us frogs in the water on the stove with the heat turned up that, hey, this water is getting hotter. We're about to boil. So that, I think, it's coming. What's coming.